Ubiquitous forward-looking statement. I'll just briefly touch on the management and the board, then I'll get into some of the results from the PEA, and probably more importantly, as Eric alluded to, how we can lever off that PEA into some value added that'll allow us to monetize Vendetta, which has been the goal all along. We've had the project for 4 years. It's located in Australia, one of the best mining jurisdictions in the world. And I think we've had a lot of success technically. We've met our goals, which we stated 4 years ago, which was to triple the ore body, which we've done. We can now demonstrate the economics. We believe it's viable. Where we've been wrong, we're right on metal prices. I think where we've been wrong, we misread the market. We didn't see re-ratings when we met those milestones afforded to base metal companies. And it is a difficult environment right now, but one that I think these markets will eventually pay for fundamentals, and I think we've established those at Vendetta, and I'll walk you through those. So I'm 23 years in the business. I'm responsible for the financial and the marketing aspects of the company. I'm the CEO, founder, and president. Peter Valgaris is also a founder. Peter's background is he's a mining engineer and geologist. He also is a consultant to Dundee Precious Metals, does peer-to-peer analysis for Lundin Mining, and is a current consultant for Goldcorp on the Newmont merger. David Baker is a CFO to Robert Friedland on one of his private companies. He's also the former treasurer of Ivanhoe Minerals and helped with Robert raise $5 billion for the Oyu Tolgoi project in Mongolia. And Doug Flagg is a former institutional sales at BMO, where he was the managing director for global mining, and he's a current partner at Cairn Merchant Partners. So as I mentioned, we're located in Australia, Queensland to be exact. Queensland and Western Australia, I think, are the two premier mining regions in Australia. Fortunately, the government was just re-elected last week. It's a pro-business government. They've vowed to reduce the corporate tax from 30% down to 25%. And what that would mean to Pegmont, based on our preliminary economic assessment, it would impact the NPV post-tax by 10%, that move in the tax. So we're very pleased with that. It was a bit unexpected, but nonetheless, it was a pleasant surprise. The key two tenets in Australia is the jurisdiction and the infrastructure. It allows a project like Pegmont to move ahead, given it will afford us a lower capital cost, which I'll get into in just 1 minute. Some of the things close by are we've got access to smelters. We've got the Mount Isa lead smelters. It's 4 hours away by truck. We're close to existing haul roads, 3.4 kilometers. We can hook up to those haul roads. We're close to rail, 17 kilometers to railhead, and that would afford us to go to the coast in the same day to the Sun Metals zinc smelter, which is owned by Korea Zinc, and we're 15 kilometers away from a gas pipeline. We are also right now doing trade-off studies looking at solar at Pegmont. One of our neighbors, Cannington, which is owned by South 32, it looks like they are going to go to solar energy to power their mine, and I think it's available. Given where we are in Queensland, it's a viable alternative. The strategy that we did execute, as Eric alluded to, we now own 100%. I think that is a key tenet moving forward. It gives us more flexibility on how we proceed and look at various opportunities. As I mentioned, the original ore body started off at 5 million tons. We've taken it to 15. We've put $9 million into the ground, and in the same time, we've increased the grade, and we've demonstrated that we've got a marketable lead and zinc concentrate, and we have maximized an open pit. The majority of our ore bodies open pit, 8 million tons of the 10 million in our resource category. And we've delivered the standalone PEA with a 10-year mining inventory. That was the goal all along. This ore body still has room to grow. We think it'll end up with a 15 to 20-year mine life, but we wanted to focus on the first 10 years, proving their economic and essentially de-risking the project. And we've done that, and we'll continue to do that moving forward. We do have additional drill targets. We are going to focus on the ones that impact the immediate mine plan, because I think that's going to be the quickest road to monetizing Pegmont. The PEA, I was asked outside what our feelings were on the Pegmont PEA. To use baseball lexicon, I think we hit a triple on it. There's some things in there that we thought we'd get further value on. But the good news is I think we can bring that value in, and I'll walk you through that without spending a lot of money. I think to hit a home run, we'll need a little bit of help from the markets. But as I mentioned before, markets always are fundamental, and they do change. And, we've faced a lot of headwinds, but, shortly, hopefully, we'll have that certainly changed. So we currently have a 10-year mine life with 3,000 ton per day mill using a conventional flow sheet. 170 million capex, sustaining capital of 59 million for 229 million total. These are Australian dollars. I think that figure is a number that a company the size of Vendetta, if we wanted to, we could put that into production ourselves by various means through debt financing or offtake agreements. We have talked to or been in discussions with several groups regarding that. So it is within our realm to do that. And as I mentioned, our PEA mine inventory, 8.9 million tons open pitable and 1.7 million tons underground. Our average payable production will be 124 million pounds of lead, 50 million pounds of zinc, and 298,000 ounces of silver. We use long-term consensus pricing, 94-cent lead and $1.09 zinc with $16.50 silver, and I think that bodes well going forward. We have had a high rate of conversion for our mineral reserves to mining industry. We're above the peer average. We're converting 76%. On our recent drilling in the open pit portion of the ore body, we're hitting on 90% of the holes, and we hope that continues as we move forward. And through the PEA, we've identified various value-added drivers, which I'll quickly walk you through a couple. We're going to drill around a couple of the known zones, see if we can bring them together around Zone 4 and Zone 3. That will help us lower some of our capital costs. We might need only one ventilation shaft rather than two, and it'll add to existing tons to the mine plan. One of the things I want to bring to your attention, our Zone 5, which was our high-grade zinc zone, as we go down dip, we did not get that put into the mine plan. We need to add another 20% to that resource. It's completely open, but that's ore that would have come in years 11, 12, and 13. We are going to focus initially on ore that we can bring in immediately, because that impacts the net present value of the bottom line quicker. We also have some exploration targets that will immediately impact the mine plan. Our bridge zone, which is our highest grade to date, as part of that mine plan, we think we figured out the geometry there. We're going to go back and drill that. And also some of our Zone 3, there's some holes, and there's a new zone that we've identified that we're calling the zero target that could be brought in, and that would come into the mine plan within the first 5 years. There's some metallurgical opportunities. As I mentioned, we have a marketable lead concentrate and a zinc concentrate, but I think by using optical sorting methodology, we're currently looking at it. We call it spreadsheet mining. It's basically seeing if it makes sense to pay the capital and what the results will be, but that looks very promising moving forward. The type of ore that we have, we think it'll work well and could significantly impact our net present value. One of the other things on the potential grade, we drilled 200 drill holes into Pegmont out of the total of 500. Of our 200, on average, we were 18% higher grade. And I think the simple reason is we use diamond drilling versus the majority of the previous drilling was RC, which doesn't reflect the grade as well. We need to do a study. The engineers would require a study to bring the overall grade up to match what we've been drilling, and that's about a $40,000 to $50,000 exercise. But I think in the overall grade could go up as much as 10%, which goes immediately to the bottom line, and we will do that this year as well. One of the other things that I think a really big advantage that we have being in Australia is that we are looking at listing on the ASX. That exchange is how the TSX used to be, I would say, 5 to 10 years ago. There's liquidity. There's institutions buying mining stocks. In Australia, every Australian has to put money into a superannuation fund as part of their retirement. Those superannuation funds or pension funds will buy ASX companies, and the Australians are predisposed to mining. They like the extraction industries. You know, someone mentioned that all of their health care is paid for by the corporate tax developed from the mining companies. So they're very pro-mining, and I think there's an arbitrage there between our current value and what we see in our peer companies listed in Australia. Just in general, the Australian companies are 2 times, the base metal companies are 2 times higher than our valuation, and our peer companies are anywhere from 3 to 5 times. So I hope by the end of the year or Q1, we'll have our Australian listing. It'll allow us to dual list both on the TSX in Australia, and then if the Australian institutions want access to Vendetta stock, they would come to Canada, buy it, then repatriate it. It's a fairly simple process moving forward, and that's one that we have underway. We're talking to several groups regarding that. Just in summary, I think the PEA demonstrates we've got a viable project and a path forward. We've got cost-effective value drivers that we're going to pursue in the short run. We've got our 100%. That's key as we move towards different opportunities. And I think the ASX gives us a bit of a leg up as far as access to capital and also market valuation. And we are going to continue to explore various opportunities with the idea of monetizing Pegmont, hopefully sooner than later. Thank you very much.